I'll kick us off with the first 7 stocks. Sort of like give you a little bit up front that all of these are actually from my portfolio because I was quite late to writing these because we had no other content. So my first stock is was a late swap in because I realised the other guys hadn't taken it, and it's Disney. And I really want to give you just the stock, and I think we've got a couple of lines on each one because otherwise we'll be here all day. But Disney, huge IP library, gives Disney a really diverse range of content that's just going to be unique to Disney. It looks expensive if you just lazily look at the metrics, and you'd probably even spot a decent pile of debt, but there's no worries about Disney not being able to manage this. They'll sail with this level of leverage. I would expect Disney to make sort of Netflix level margins on Disney Plus in the future, and when it does, everything about this stock will look a little bit cheaper, and it'll still have all the other benefits that it has today. My second stock is Forterra. Now, you may not have come across this one. It's a bit of a sleepy stock in the UK. The UK desperately needs houses, and at the moment we cannot make enough bricks to make those houses, so we have to import them. Forterra is currently remodelling all of its factories, whilst it's a bit quieter in the building trade, to actually fulfil that brick need. It should do well as we leave higher interest rates and we start building houses again, start doing extensions, etc. Bricks aren't actually a commodity like you'd think they are. When the first thing you do when you do an extension or something like that is you have to get a brick match. Forterra make the London bricks, and it's in about a third of our stock in the UK. So I would argue they'd almost definitely have a moat. My third stock is Four Corners Property Trust. So this is a pretty cheap looking real estate stock. It's in a recession resilient part of the US economy. Its customers are people like Burger King and Olive Garden, companies like that. It's got smart leadership. It's conservatively run. It gives you a healthy capital return, dividend north of 5%. Base rent is growing at about 11% CAGR, and base property is growing at about 14% CAGR, and all of those properties are triple net, which means that the expenses are all passed on to the clients. So it's good. Progyny is a fertility benefits insurance company. Fertility rates are falling throughout the world. It's a really worrying trend for the human race, essentially. But the company addresses this in the US. Its stock price has actually already been hit hard by the layoffs, despite them actually growing their covered amount in the last year up to 5.4 million. This number is actually still forecasted to rapidly grow and to not decrease. So not an expensive stock at the moment, and one that I think is definitely worth a look at. Take-Two is my next stock. It's the owner of Rockstar Games, the makers of Grand Theft Auto 6, already issuing for the biggest game in the world whenever it releases. It's going to generate significant revenues, we know that. If they monetize the online version of it like they did with its predecessor, GTA 5, this could run for nearly a decade. Look out for more mobile content this year too, because they've just acquired Zynga, and we are waiting for that to bear fruit. Salesforce is my number 6. I said to Steve the other day that we're at peak fear with Mark Benioff, the CEO. I think they've cut staffing back very deep, including a lot of people at the top, which is unusual, and their sales cycles have almost definitely lengthened. But it won't be like this forever, and Salesforce has really, really ambitious plans, starting with a very large buyback, which definitely points to a more sort of shareholder-friendly environment, shareholder-friendly business going forward. My last one is Sonova. It's a Swiss stock, and a few years back you'd have looked at this and said it was a little bit sleepy. Specialises in mid to higher end hearing aids and listening aids. Today it does all of that, plus it has a robust clinic network throughout the world, and it also owns the Sennheiser headphone brand. So this is a company that could be in your ear in one way or another for all of your life.
Lots of things end up in my ear. Steve, for that's quite an advanced portfolio, I think, for beginners. That's my only downside to that, I guess. But really interesting Forterra, actually. I was just looking them up after you mentioned them there. Very interesting financials they've got there, but very terrible. A bit of a terrible past 6 years they've had on the market. They've basically been flat, haven't they? So, yeah, very interesting one that you picked up there. That's good.
They do pay a big old dividend trading sideways, though. You picked up about 5% a year or something like that. Yeah. I mean, you wouldn't have got much by the stock going anywhere, but...
Yeah, and buybacks as well, so that helps that dividend grow as well over time.
Yeah, 5% dividend on the flat. I mean, when I say it's flat, it's 5 years, it's up 15%. So you are still getting like 6% a year there, which is
It's
pretty good,
difficult to judge though because it's just had a big fall. If you was taking it back from just a few months previously, you'd have been looking at a much
it's
sweeter
massive,
return.
yeah.
It's fell with the general housing market.
Yeah, pretty good.